This is Mark Sobel. I'm the U.S. Chair OMFIF. Today, in advance of next week's FOMC meeting, I have the delight to be joined by two distinguished economists, Seth Carpenter and Sonal Desai. We're going to discuss the U.S. and Fed outlook. Seth is Global Chief Economist at Morgan Stanley. He's worked at many other financial institutions in senior roles, and he served with distinction as a longtime monetary and financial policy expert at the Fed and Treasury. Sonal is Executive Vice President and Chief Investment Officer for Franklin Templeton Fixed Income. She's one of the top leaders of Franklin Templeton, and also has a strong background in international macro and emerging markets, including serving for quite a few years at the IMF, where she had the fortune or misfortune of meeting me. I plan to put questions to both of you for up to the first half of the session. Hopefully you'll be pithy and get your general views on the table and turn it over to the audience. I've asked my good friend and colleague, Steve Kamen, now at AEI, formerly head of the International Finance Division at the Fed, to kick off the audience discussion. Questions can be submitted by the chat function. We're on the record today. Welcome, Sonal and Seth.
Excellent. Thank you very much for having us.
Great. Well, let me go to Sonal and Seth in this order with my first question. So before we get into monetary policy, let's focus on your assessment of U.S. inflation and the outlook for prices. I mean, is inflation peaking? Is the current high inflation an issue about too much fiscal support causing a burst in demand beyond potential growth? Or is there still merit to the idea that the U.S. has witnessed a series of enduring shocks, supply chains disruptions, shift in relative prices, the Russia-Ukraine war? And how do you think about that in terms of core versus headline, et cetera? So Sonal, off to you.
Okay, so I would say, first of all, it isn't really a question of either or. It actually can be all of the above to a certain extent. I think there has been excessive monetary policy easing, exacerbated by excessive fiscal policy easing. And then, of course, the icing, if you will, on the cake was first the supply chain bottlenecks, which came with COVID, followed by the geopolitics that we're seeing currently, the war in Ukraine and the energy shock. All of this together, to me, implies that inflation is going to have some legs. It isn't as simple as seeing supply chain bottlenecks go away. And we can get further into the issue of, the unpredictability of the bottlenecks which come out of China's zero COVID policy. But I'm talking about the fact that it's a whole series of different factors. The Fed can fight some of them, but not all of them. So I think inflation might be around for a bit longer.
Yeah, so I'll jump in, and I think I agree with that sort of multivalent view of the world. The way I like to talk about it at times is to say there's some portion of the inflation that is frictional, temporary, driven by supply chain disruptions, driven by commodity price spikes, driven by all of the frictions that COVID closing the economy and reopening the economy caused, and some of that will go away on its own. But I think it's hard to argue that even with the recession that we saw, temporary though it was, with the recovery we've seen, that we're below potential in terms of levels of GDP, and definitely not in growth rates. And so there's some portion of the inflation that we're seeing, and I think even more importantly for the Fed, that we will see over the next 2 years, that is good old-fashioned overheating of the macroeconomy that needs to be addressed by restricting aggregate demand. And your list, Mark, of causes, you included policy, fiscal policy, and monetary policy. I mean, I think it's clear that monetary policy is still in an extraordinarily accommodative setting, but it's a little bit hard to sort of put all the blame there. I think there was clearly a huge fiscal impulse, and it came at such a quirky time when there was this demand shift in terms of the composition of demand towards goods that really did cause part of the anomaly. So in that sense, I think you can give policymakers some credit, blame, whatever you want to call it, but it has to be taken within the context of the lockdown and the restrictions and the shifting in preferences. And so it was, in that sense, have been a whole series of truly unfortunate shocks that have endured much longer than I think I would have anticipated.
Great. I asked the fiscal question in part because I had Larry Summers about a month and a half ago for a 1 hour discussion, and he was definitely making that case. Well, so Seth and then Sonal, so what does this mean for the Fed's ability to fight inflation? Where do you see the Fed funds rate headed? Some say the neutral rate's 2.5, and others say inflation is far, far worse, and the Fed's going to have to go much higher to uh, achieve positive rates and squelch inflation. Analysts also debate the speed of how quickly we get to wherever it is that we're going to get to. It seems 50 basis points is baked in the cake for next week. Oh, and some people say the Fed has made a massive policy mistake. You began to touch on that or not. So what's your take on those issues?
So from my perspective, I think it's very premature to say that the Fed has made a massive policy mistake. We know that monetary policy works with lags. They, if you want to argue that they were a little bit slow in pivoting from saying that inflation was transitory to something that they needed to do, fine, but I think it's premature to say it's a massive policy mistake. With regard to where the funds rate goes and what they have to do, I think there are a couple points. The first answer that I think in reality is we don't know. They don't know exactly how far they're going to have to go. Neutral is a great concept, and you can derive really precise estimates of where neutral is from models. You can never derive precise estimates of where neutral is from reality and from actual data. And so as a result, we've written down a forecast that the Fed gets up over 3% to something like 3.25% on the funds rate as a peak rate. But I suspect what we're going to end up seeing in reality is Jay Powell and the committee tightening policy, trying to find where neutral is, go a little bit beyond neutral, figure out where they can be to be restrictive, because the growth rate in the economy is clearly faster now than what can be sustained in the long run. So they want to slow the economy down. They want to create tighter financial conditions to bring about that slowing in the economy. And exactly where that level is will only be revealed over time as they tighten. So I think that fact is important, and it means for people in markets. It means for those of us who are watching from the sidelines. We're not going to know with certainty until we get there and something cracks. So take, for example, late 2018, early 2019, where the Fed was hiking. They were running off their balance sheet. Boy, that sounds very familiar. Risk markets cracked, and they reverse course. I believe that type of pattern is what Chair Powell has in mind when he talks about always being nimble. It's pushing, trying to feel your way to where things should be. And if you make a small mistake, be ready to reverse course fairly quickly. The other reason why we're at the 3.25% range as opposed to potentially higher is that the Fed is in fact running off its balance sheet. We have our own estimates for how much tightening that does, but at the end of the day, there's going to be, the proof will be in the pudding, and the roughly $3 trillion reduction in the size of their balance sheet that they're going to need at the least is just fraught with unknown ramifications for financial markets. So it could go very, very smoothly. We could rely on the fact that Treasury is issuing the debt that the Fed is shedding, and it's going to be at the front end of the curve, and as a result, less duration added to the market than the Fed had extracted in the first place. But there's no way to have high conviction on that because we only saw a partial reversal of the balance sheet expansion in the last time. And so I think it will be very instructive for the Fed to stay nimble, as Jay Powell puts it.
Thank you. Sonal.
Okay, so actually, let me take, I'm not sure I fully agree with Seth on his reading. First of all, policy mistake, I would characterize the Fed as being definitely clearly behind the curve. To me, that's a monetary policy mistake. That's how we would have read it at the IMF. Anywhere we were when we met, what was it, 25 years ago, that is what we would have characterized it. Why do I think the Fed's behind the curve? Well, look at where inflation is. And more importantly, not only let's look at where inflation is today, let's look at where inflation was a year ago, before we actually had the current energy crisis which was being stoked up. So that's number one. Number two, where do I think the Fed funds could go? I actually am of the camp that believes that the Fed funds will probably need to go substantially higher. That neutral rate of 2.25, it essentially comes with a notion, 2.25, 2.5, comes from the notion that productivity growth in the US is around 0.5, and you have 2% long-term inflation, anchored inflation expectations at about 2. So people think, yeah, 2.5, maybe a bit more, maybe 2.75. I would just note that pre-global financial crisis, that neutral rate was considered close to 5. So I agree with Seth, it's very fuzzy, that concept of where neutral is. At that point, we had much higher productivity growth. If I look at the last 3 years, productivity growth has been closer to 3 than to 2.5. And inflation is, of course, what we think it is right now. And that, even if we look at long-term inflation expectations, would deliver a substantially higher Fed funds rate. Nonetheless, we do have the Fed going through a runoff. And I'm just throwing it out there. I would not fully rule out that if inflation does not come down swiftly enough, they might be forced to actually actively reduce something right now, even the most hawkish member of the Fed has not acknowledged a need to do, i.e. actually selling as opposed to just a runoff. So these factors together, to me, I would say, could lead you to a Fed funds rate of easily over 4%. And the other point is the speed at which we get there. I think we could get to 3.5 as soon as the end of this year. Yeah, so I think that we're looking at a much more front-loaded Fed. In turn, hopefully this brings down inflation expectations. The last point, which is, a couple of more points I'd like to make. 2018-19, this is exactly true. The Fed has been nimble over the last post-GFC period, the last 12, 13 years. It has conditioned the market to believe that it will step in. If the market gets fearful, if it cracks, the Fed will step in. I would note that in 2018-19, inflation was sub 2%. Today, we are likely to see the market fears emerge when inflation is substantially above 7%. Just baked in the cake inflation, right? We can do a very simple calculation. How much inflation have we had so far this year? What was the average month-on-month inflation over the last 12 months? Drop that to half. So you take your 0.7, drop it to something like half, 0.4. You still end this year at close to 6% or above 6% inflation. These factors together, to me, mean that the Fed is not going to be in a position to bail markets out. I'm not sure markets have acknowledged that yet. And so I would say, to me, I would actually be looking more at the 70s, and that's pretty frightening. I get it. I'm not talking about Volcker-esque, the need for Volcker-esque increases in interest rates. I do think that I read a very interesting paper by Blanchard just yesterday, and he's looking at this in a different way. He's looking at the real Fed funds rate, and he's comparing that to core inflation, with real Fed funds being defined as Fed funds minus 12 months core inflation. That difference was 17% back in I think it was 74, 75 at peak inflation. Today, that number is 12%, right? The difference between the gap between real Fed funds and core inflation. That is the biggest gap we have seen since the 70s, right? So this to me is something which gives me some concern about being sanguine that Powell will be able to be nimble and come right back out and bail all of us in the market out. I don't think it's going to be that easy.
So a logical follow-on then from that question for Sonal and Seth is, can the Fed stick the landing? Are we headed towards a recession at some point in the coming years?
I would just say that in the coming years, I think actually, yes. I don't think that the business cycle is dead. That was wishful thinking, much like the idea that the US could run, I think about it as modern magical theory, but modern monetary theory, whatever you want to think about it, that it could do this, that it could run unlimited deficits, unlimited monetary and fiscal easing with no consequences. I think there are consequences. I don't see 4%, 4.5% immediately driving a recession, simply because a lot of those, the 1.9 trillion, 900 billion, another 1.9 trillion in fiscal expansion has ended up in the savings of consumers. So consumers are still, demand is pretty strong still in this economy, despite that high inflation rate. So I think we will get a recession, but maybe not for a year and a half or two. It depends on how long consumers can extract their savings.
Yeah, so can they stick the landing, I think, is a fantastic question. And the answer is we don't know, remains to be seen. It will be difficult. It seems from public speaking and other commentary, Jay Powell and the rest of the committee sincerely believe they can, and that's sincerely what they're trying to do. So it's not a Volcker-like period where they're intentionally trying to engineer a recession to get there. But I sort of have used the metaphor of it being like trying to land a jet on an aircraft carrier in a storm, having seen one training video and never been on a training run before, right? So it's going to be fraught with error. And it really will come down to how quickly and how correctly they're able to read the writing on the wall in terms of the reversal of policy when things start to crack. So I completely agree with Sonal. There's no way they're going to be able to fully insulate markets. But therein lies the challenge for them, is that they don't want to. They want asset prices to go down. They want financial conditions to be tighter. I mean, by definition, higher interest rates are lower asset prices for fixed income instruments. So they're not trying to avoid hits to asset prices. In fact, they're trying to cause lower asset prices, but they want to do it by enough to slow the economy, but not so much to cause a recession. And that is a very, very, very narrow landing strip. And it's going to come down to a question of their ability to judge in real time how much the economy is slowing and hopefully not overdoing it.
May I ask everybody to mute their phones or systems? Thank you. So Seth, you held the pen on FOMC statements for a while, along with some others, but you were prominently in that capacity. How should the Fed communicate its views? What thoughts do you have on that, especially given the speed at which they may or may not move? And I've had the sense that at recent press conferences and other statements that Powell has been talking with a bit of hawkishness, with the aim perhaps of tightening up financial conditions and letting the markets do some of the work for the Fed. Do you agree with that assessment?
I do agree that he's been trying to convey the sense that they don't see themselves behind the curve, that they think of themselves though as very committed to bringing down inflations, and the market doing a bunch of the tightening for them is, I think, 100% in line with the way the center of the committee thinks. How they communicate or how they should communicate is a little bit of a difficult question, because they're a little bit stuck. So when Ben Bernanke came in as chair in particular, his philosophy in part was let 1,000 flowers bloom, let everyone have a voice, let everyone do as much talking as they want. That tradition has continued since then. And so as a result, we have a great deal of noise, lots of different members of the committee, participants on the FOMC committee, talking in markets. And I think it's making it a little bit harder to get a real good signal. So when I talk to my clients, I tell them, put almost all of the weight in Fed communications on Chair Powell. Next, Lil Brainerd as vice chair of the board, and then, but really just pay attention to Powell. But it's hard, and it's hard for markets to sort of distill the signal from the noise. So how should they communicate? I think now we're going to see a point in time where having press conferences at every meeting is actually a very, very helpful thing for Powell to be able to communicate what they're doing, to be able to again, be nimble and respond. If the market thinks that they have missed a turn in terms of how quickly the economy is changing, you'll see it in terms of the reaction to those sorts of press conferences. So I think that every meeting press conference is helpful here, being very frequent in his discussions to tell markets and the rest of the world how we're going, how they're interpreting the data is going to be critical.
Donald, any views?
Yeah, actually, I'd say I fully agree with everything Seth said. And I would add to that potentially in June, to start getting serious about those dot plots. The last set of dot plots were internally pretty inconsistent. Again, always looking at the real interest rate. I was looking at that, and you had a terminal rate which was something around 2.73 or so, and then the Fed was clearly looking within the time horizon to cut rates. And you got inflation essentially coming down by itself, and this is in March, inflation coming down by itself, while real rates were negative for most of the time period, and we ended the period with real rates barely positive at 0.2%. That indicates that at some level, what the Fed was still signaling was they really thought inflation was temporary because it was going to come down by itself. In the sense, yes, you had some policy tightening, but that little bit of tightening was enough to bring inflation down. I think the dot plots are an excellent mechanism. Clearly, those dot plots are just, Jay Powell has been at pains to say that the dot plots are not, the median dot plots are not an indication of future policy. It's an indication of what people on the committee were thinking. But what they were thinking didn't make much sense on the median level if you sit and pore over those dot plots like we tend to. So I think that would be a good place to actually start getting more serious in the signaling side. Agree that the market has done a lot of the tightening. Obviously, the Fed needs to validate that market tightening, which is already baked in, by delivering those rate hikes, but then also anything else which needs to be done.
Okay, let me ask one last question. Seth began to touch on it already, but what are your thoughts on balance sheet policy, what the Fed should do on quantitative tightening, and what's the relationship between balance sheets and rate policy, and can balance sheet policy substitute for rate hikes? And if so, do you have any numbers in mind? Sonal.
So I'd say that for me, it's not a substitute. I think it's and. The Fed has a monetary overhang, right? A $9 trillion balance sheet. For the economy to grow into that balance sheet would take too long. So they need to reduce the size of their balance sheet. I would say that this would be a great time to actually ensure that the yield curve stays upward sloping, apart from everything else, because I would say that's something which the Fed could focus on quite usefully. I'm not sure that runoff by itself will pull that off, but the combination of runoff rate hikes potentially does that. I don't have a number in mind, but I do think a faster runoff probably would be a great indication, or stronger runoff than is currently anticipated would be a great indication of the Fed's commitment to bringing inflation down and regaining some credibility, which I think actually has been lost at this point.
Yeah, so just in terms of mechanics, so what they've communicated is, especially in recent communication from Lil Brainerd, that they'll likely make the final announcement that they're set to start running down their balance sheet at the May meeting. That runoff will start in June. They'll take about 3 months to get up to the runoff that they have in mind. And that's sort of a limit of $60 billion per month in treasuries, but they're going to hit that cap, reading through the minutes of the last FOMC meeting, by letting their bills holdings run off whenever their coupons aren't enough. And then they've got this limit on $35 billion per month of mortgage-backed securities. Generically, they're not going to hit that cap with the likely path of prepayments from their mortgage-backed securities portfolio, and so you'll get a runoff of a little bit less than 90 or $85 billion per month. Where they said they want to be is to more or less get that runoff going. I suspect in terms of communication, Powell will avoid using the phrase autopilot this time around. It didn't get digested quite so well by markets last time, but they would like it to run roughly in the background without having to make frequent adjustments to it. I think the reason for that is they've had more experience with the federal funds rate. They feel like they can make more and finer adjustments with that. You can do 25 basis points, 50 basis points, 75, blah, blah, blah. Whereas with the balance sheet, calibrating changes, I think they see as much more difficult. Where is it going to go? Our view is they're going to end up with roughly $6.5 trillion on their balance sheet at the end. That's going to be determined by some technical factors that, to the extent, Mark, you have insomnia, we can get into the details, but that comes sometime in 2024 by our calculations. I think the open question is, are they going to sell their mortgage-backed securities on an outright basis? There's a lot of chatter about that in markets, especially, unsurprisingly, in the MBS market. this is something that the Fed had debated before and decided against last time around. This time, judging from the minutes and other discussion, it's clearly on the table for discussion. Our judgment is, under our baseline forecast, they will not end up selling mortgage-backed securities on an outright basis. And the logic there is our housing analysts see a very sharp deceleration in housing activity, especially existing home sales over the next 9 months to a year. And the housing sector has always been the sort of most sensitive part of the economy that responds to monetary policy. And so if they're worried about overdoing it, the uncertainty about what mortgage sales would do, I think, is the thing that stays their hand, since they're already going to be seeing appreciable slowing there. Clearly still in debate, though, and if everything's just much stronger, they have it. So what does that mean? That means that they have at their disposal an ability to shrink their balance sheet faster, if in fact they feel like they need to do even more restraint. At the margin, though, I think it's going to be the funds rate that does it. And so if they don't get the slowing that they want generically, but they do get some slowing in housing, I think that then you're just going to see more in the way of interest rate policy. So in that very specific sense, I think of them as substitutes. They're going to be used together. And so I agree with Sonal that it's not an either or, it's both and. But when it comes to a marginal decision of, we want to do more tightening, which policy tool are we going to use? That's the sense in which they're kind of substitutes. And I suspect they're going to err in general on the side of interest rate policy.
Well, fantastic. Great answers to all my questions. So I'm going to ask Steve Kamen to kick us off for a few brief moments with some comments and questions if he'd like. So Steve, over to you.
Thanks, Mark. It's good to be here this morning, and I very much enjoyed Sonal and Seth's remarks. And of course, it's good to see Seth again, my old colleague at the Fed. So I wanted to, start by kind of asking about Sonal and Seth's views on the issue of, that's received a great deal of buzz, which is the Fed's policy mistake and the Fed being behind the curve. And kind of like the narrative that you hear all the time is that because the Fed's fallen behind the curve, it's going to have to hike rates extra quickly to get back to or ahead of the curve. And that's going to push the economy into recession. And I'm wondering, really how much weight there is to that argument. And so I was kind of thinking hypothetically, let's say that the Fed had recognized somewhat earlier, that it had an inflation problem. And just kind of ballparking it and looking at inflation, it kind of looks like last October might have been the point at which it looked at core inflation, noticed that after having dipped a bit from a few months earlier, it was starting to move up again. So the Fed had started in October, okay, let's start raising rates by 25 basis points a meeting. And so my point is, if it had done that, then right now, it'd be looking at interest rates that were a bit above 1%, but that were only 75 basis points higher than they otherwise would have been. And I guess I question whether having started to raise rates earlier in that way would have actually made much of a dent in the inflation rate we have now. And I also question whether if the Fed decided that it wanted to make up that last 75 basis points over the next several meetings, whether that would be enough to actually push the economy into a recession in a way that would not have been the case if it had started, raising these rates somewhat earlier. I have a little bit of a personal stake in this, in that I have bets with two of my colleagues at the American Enterprise Institute. I have bet each one $50 that the US economy will get through the end of 2023 without 2 consecutive quarters of GDP decline. So I have a huge amount of money on this. Very interested to hear what Seth and Sonal have to say. And then just to kind of add on to that point, I believe at the last press conference, Chair Powell kind of suggested that the Fed might, by raising rates, be able to lower demand back towards supply without actually reducing economic activity. And I have to say, in my 30x years at the Fed, I've never really heard such a theory articulated. I was wondering what they thought of it. And then as another kind of related point, when the yield curve has gotten inverted, of course, there's always a lot of buzz about that signaling recession. And yet that goes against the narrative that the Fed may have to raise rates temporarily for a while and then bring them down. So I'm wondering what they think of that too. And I will stop there.
Seth, are you starting? Or am I starting?
After you, I'm happy to follow up on your comments.
Okay, so first of all, thanks for that series of questions. I'll try to get to some of them, probably not all of them. I'd say the first thing is it's not really October. I think that when that 1.9 trillion passed, that fiscal piece passed in Q1, they didn't have to start raising rates then, but they could have stopped expanding their balance sheet then. It became pretty clear that the economy, the two other factors we have not talked about, the economy was reopening, vaccines had been delivered. So, the artificial closure of the economy, the artificial recession was in the process of being unwound. So number one, I think that they certainly could have tightened earlier. And, the signal it would have sent is a very simple one, that the Fed continued to look at both its mandates, not simply growth. That's number one. And I think if it had started doing it at that point, it's less about where the rates would be. It would have been more about where expectations on inflation would be. Inflation expectations, inflation would, from supply chain bottlenecks would still be higher, but the piece of inflation the Fed could influence, which is monetary policy and fiscal policy impacts, that would have been a bit more under control. And I think that the credibility issue would stop being as much of an issue. The Fed would be doing what the Fed always should have done. And that's number one. I think on the issue, I'm just going to talk briefly on the yield curve recession, because I think I might have forgotten what the middle one was. But the yield curve signaling recession, I think yield curve doesn't, right now. The yield curve, at this point, the Fed is a major player. It's almost 25% of the treasury market, right? So at this stage, I don't see the yield curve signaling what it's supposed to signal anymore, because a large part of it is out of the control of markets, number one. Number two, I would say that the yield curve actually reflected to some extent the idea of the dot plots, that the Fed was going to cut. After raising, it would cut. And so it's not that it's signaling a recession, it's signaling markets' expectations of how long the hiking cycle was going to go, that brief period of inversion, I would say. So that part, I really don't take away yield curve signals the way they have been read. It's just not giving us that information anymore. And I'm really sorry, but I forgot the middle one. There was another part of that question, and I've forgotten. Seth, maybe you remember.
Yeah, I think it was if they are behind the curve, does that mean that they have to do more, and that will teleologically lead to a recession?
So no, I think it's not so much that I do think that there's going to be a growth slowdown. Whether we get 2 quarters of negative growth before the end of 2023, I actually doubt that, but it depends on 100 factors which actually are not in the Fed's control. The external factors, which include energy prices, all these other items. I've been pointing out to our clients for quite a while now that actually, if you look at the US consumer in real terms, the US consumer spending power, so you take personal consumption deflated by the PCE or anything you want to choose, it's actually still higher than pre-COVID. So essentially, those helicopter drops of cash over the last couple of years, together with the fact that consumers were not able to actually consume, have left to a substantial buffer. So I think that buffer takes them forward for a bit longer, and that's going to help avoid that recession. So I'm going to leave it at that and turn it over to you, Seth.
Thanks. That's great. Yeah. I mean, I think a slowdown in growth is almost inevitable, but it's also highly desirable. Steve, if I read what Powell was saying, and maybe with over generosity on my part to interpret it, what I think he was trying to say was he wanted to use policy to slow demand, in fact, actually slow growth down, but not have a contraction in economic activity and not increase the unemployment rate appreciably. And, I think it was in the context of all the measures people have of how much tightness is there in labor markets and looking at job openings and that sort of thing. So if you could keep employment roughly constant, but bring down demand for labor so that there aren't the sort of millions of openings, then he'd feel like they're in a better position having less inflationary pressure. all of which I really took as just a slightly generalized or specific version of the overall notion of a soft landing. Can we slow aggregate demand enough so that we don't have inflationary pressures, but not so much so that we have a recession? So in some sense, perhaps the Holy Grail, but that's where I think, or at least hope, that he was going with those comments. So what does that mean? I think to answer your question, if they, how soon should they have recognized that they had a problem? When should they have changed policy? I mean, I perfectly agree with Sonal that their balance sheet policy almost surely went on at too high a rate for too long. I had written a piece at a previous employer back in June of 2020 that the rationale for the $120 billion per month open-ended flow of purchases could probably come down at that point, because it was both the macroeconomic effect as well as a market functioning argument. And by June of 2020, I think you can't point to both of those things. And so had they that many years prior already ratcheted down the size of their QE, it would have been easier to pivot out of it. The tapering down from 120 to zero is just harder for them to countenance than to go down from something smaller like $50 billion a month to zero. So I think therein lies perhaps one of the seeds of the challenges. I'll quibble a bit with Sonal about what they could or should have done in reaction to the fiscal stimulus, but it's literally just a quibble. I think the mistake that was made there, and I am guilty of this myself, was not a mistake of policy, it was a mistake of economic forecasting. So they saw the fiscal package, they saw the amount of stimulus that was going in, and yet the forecasts at that time for inflation were still benign. So if those forecasts had been right, then we wouldn't be having this conversation about a policy mistake. So in that sense, very, very cold comfort, I admit, it was initially an economic forecasting mistake, not a policy mistake. But again, I admit that's a very fine distinction to be made at this point. So does it follow that being behind and needing to catch up means that you're going to have a recession? And again, I think the answer to that is probably no, but it does very much get back to a question, or at least one of the framing I like to do about inflation right now, which is how much of the excess inflation that we see now is this frictional inflation from supply chains, from commodity prices, from the closing and then reopening of the economy and the labor market reshuffling, most of which should resolve itself, and how much of it is the real standard textbook macro inflation that can only be gotten rid of by having GDP in level terms being below the level of potential GDP for a period of time. And so if the answer is it is all temporary, then I think reasonably clearly the answer is no. They don't have to cause a recession. They will see inflation starting to come down. They can raise interest rates. They can monitor sort of what's going on with the economy, and things will get back to normal. That would be a fantastic world to live in. I'm not at all convinced that's the world we do live in, but that would be one extreme. The other extreme is that it is entirely driven by standard macro overheating, and we have to have an output gap that's big enough. And take whatever estimate you like of a Phillips curve type framework or an output gap driving inflation framework, whatever estimate you like there, and you think about the coefficient there. If all of this excess inflation is coming from that, then you have two choices: either a recession that is really big, or many, many, many years more of inflation as they very gradually chip away at it without getting a recession. So it's not whether they are sort of hiking too late and need to catch up. The real question is going to be what's driving the inflation? How does inflation evolve over time? And again, I've got my view that less than half of it is the macro version of inflation, but forecasting is hard, especially about the future, and I could clearly be wrong. And so this is why I think we're back to what I suspect is going to be the strategy and the execution from Powell and company, which is continuing to tighten, trying to see when they get to a point where they get some traction in slowing the economy down and trying to get growth down below potential. And then if they get the sense that they've overcooked it and we're going even further to negative growth, then they'll be reversing course.
Great,
Mark, could
great.
I interject for just a second?
Okay, lightning.
I feel, yeah, I think those answers were great. And I just wanted to mention, I completely agree on the point of that the QE went on far too long and its rationale had evaporated very early in the pandemic. So that in particular I agree with, as well as nearly everything else that Seth and Sonal mentioned.
Oh, great, great. Sonal, I wanted to tell you that quibble is a favored word of the Federal Reserve that I heard many times over my career.
Yes.
So we've got a bunch of questions, but I want to turn to Arnab Das because I thought he had a good general question to kick us off. And so Arnab, would you appear and offer your question quickly?
Yes, sure. Thanks very much, Mark, and thanks very much, Sonal and Seth and Sonal. Very nice to see you.
Hi, Arnab. So good to see you.
After many, many years, indeed. Okay, so I wanted to ask, I mean, I think it's a great discussion about the US, and I agree with a lot of what's been said, quibble with some of it, but I won't go into that. I wanted to ask, kind of take a step back and ask a question about the fullness of time in this tightening cycle. If we look back through Fed cycles, not only is it hard and rare for the Fed to achieve a soft landing in the US, I think it's also the case that, you know, if the Fed carries a tightening cycle through to term, usually something big in the world breaks, right? There's usually a crisis, financial crisis somewhere, not always, but sometimes even in the US, but almost always somewhere else, you know, Chinese devaluation here, Mexican crisis there, you name it. What do you think is going to happen this time, given what you've said about the need to carry through with this tightening cycle quite a ways and the difficulty of achieving a soft landing in the US? And then if I can just ask another kind of over the horizon structural question, right? You know, explicit and implicit in what both of you said, a lot of it is that there's a lot else going on here besides the demand side. There's the supply side. There's also a lot of structural change, the reallocation shocks during the pandemic. I think it's fair to say, you know, we've been hit by a series of these kinds of structural shocks, starting with GFC, Eurozone crisis, the Chinese devaluation, Brexit, trade war, and then on top of the pandemic, this war, which is going to change, at least you know, it seems likely to change quite a lot of things in the world. So I think my question would be, what do you see as the role of the Fed and other major central banks as all of these structural changes, which I suppose are going to be primarily on the supply side of the economy, how is that going to affect monetary policy? Two very easy questions.
Seth, lobbing it at you.
Excellent. So I'm going to take that great framing and recast it in summary, hopefully in two questions that I think are what you asked, but are ones that I think I can answer. What's likely to be, where should we be looking for the most likely culprit of the shock that derails this tightening cycle? Because things often go wrong. And so what could it be? I mean, anytime you write down a forecast, almost by construction, you don't forecast the shock, but so where should we be looking? And then the second one is, what's the role for central banking and monetary policy when you're living in a world where supply shifts are at least as important, if not more important than demand drivers. And if that's not the questions, those aren't the questions that you asked, those are the questions I'm going to answer anyway. So, I mean, I personally have written either directly or with my team on two key shocks right now that I think could get in the way of the Fed, the expansion now, if we were looking for what might cause a recession in the United States over the near term and cause Steve to lose $100, what could make Sonal wrong about how high the Fed funds rate gets to? I'd point to the Russian invasion of Ukraine and all the news stories and how it's been evolving over the past couple weeks with the potential cutoff of energy to Europe. So far, manageable, but the direction of travel is pretty clear. And if we were to have a very abrupt cutoff of all energy commodities from Russia to Europe, I think that's pretty disastrous for Europe. And I think that kind of adverse hit to Europe does not leave the US economy unscathed. And so to that end, if what the Fed's trying to do is slow down economic growth through tightening monetary policy, that's going to be a shock that would slow down US economic growth and as a result, presumably lead to a bit less in terms of tightening because you'd be getting some of the slowing going from a different source. I think the other shock I'm paying attention to and worrying a little bit about is everything that's going on in China right now. So shutting down a city as big as Shanghai, I would have said 2 years ago would have been unimaginable. It's astounding to date. Their ability to have these closed loop manufacturing setups means that what we're seeing is more a demand shock, presumably, than a supply shock, but remains to be seen. And there's nothing that's guaranteed there. And so to the extent that you had a much bigger hit to Chinese growth that is both a global demand shock and a global supply shock, boy, that feels very, very uncomfortable in terms of what it could mean to economic growth everywhere. Ends up being a little bit ambiguous as well for policy, as I'll get into in the second question, because if there's a big supply component to it, presumably keeps inflation high. And so it's hurtful, but the slowdown in demand clearly makes growth lower, and that could very much be the thing that derails, if not the expansion, if not the hiking cycle itself, at least the expansion. I think it's a big risk that we need to monitor. And then whatever the joint probability of those two things happening at the same time, sort of a much worse development in Europe and a much worse development in China, well, let's just call that the Full Employment Act for economic forecasters, right? Because it's just going to be complete turmoil. So the second part of the question then, so what is the role of central banks now in a world that's more heavily influenced by shifts in supply rather than shifts in demand? One phrasing that I somewhat reject is, gosh, what's going on is just a contraction in supply, and as a result, there's no role for monetary policy because monetary policy can't fix supply shocks. I think it's true that monetary policy can't fix supply chains. On the other hand, at the end of the day, if we are seeing a sustained and fundamental leftward shift in aggregate supply, if we're seeing a sustained reduction in the productive capacity of the US economy, of the global economy, I think the prescription is you want to rein in demand so that it's roughly in line with supply so that you achieve your price targets. If the productive capacity is in fact impaired, that is just an unfortunate fact of life. I think most of us who studied sort of mainstream economics would say aggregate supply is more or less a parameter given by the model, given by endowments. There could be some endogeneity of aggregate supply to aggregate demand, depending on how investment goes, blah, 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 blah. But in the bigger sense of things, you play the hand that you're dealt, and the central banks are being dealt what's going on with the ability of the economies to supply things. And if that's fairly permanent or at least very long lived, then their role is to try to calibrate demand to be roughly in line with supply.
Yeah. So, adding to what Seth just said on the issue of Europe, absolutely, this is huge, right? I mean, they actually did cut off gas to Poland and Bulgaria, so you can see that there is the potential for this to be very, very negative for Europe. But keep in mind, Poland has been trying to get the EC to allow it to frack now for the better part of I don't know how many years, and the European Commission has said no. The European Union, the 17 countries, sit on frackable gas, which would actually keep them supplied in energy for the next 30 or 40 years. Having said that, I'm not suggesting that Europe is suddenly going to go on a fracking binge, but it's in the Northern Hemisphere and winter comes. If there is no energy, it's a very predictable shock to the economy, even before we start talking about the damage to industry. There's the fact that people need heating. It's one thing to say, turn down your air conditioning, turn down your heat by a couple of degrees, but it's a very serious thing in the Northern Hemisphere. I think Europe is I've been a bit alarmed at how little they're doing to try and preempt this cutting off of supply, especially the two countries which are most exposed to this. This is Italy and Germany. But I have to believe that between now and say November of this year, they will start looking how to speed up some diversification of their energy supply. So I hear what you're saying, and it would be catastrophic because there's no way Europe can fall into that style of recession without having an enormous negative impact on the US as well. And you're right, in that situation, Seth, I don't think the Fed needs to do as much because you do get that recession, right, which is going to slow things down. China on the supply chain issue, absolutely, completely agreed. The zero COVID policy, our read is, at least through the end of this year, through the People's Party Congress, she is going to stick to this. So it is at least one more year of ideologically driven, unpredictable COVID shutdowns, depending on the current variant, right? Whatever the current variant is. And that certainly doesn't help the global economy. Where does this show up? I think the downside risks for the global economy certainly go up astronomically, right? In the sense that you will have, if you have more supply shocks, and you have at least half of emerging markets who need to import commodities, you're going to have an overall situation where the downside risks to growth continue to increase. I'm not suggesting for a moment that global growth is not going to slow as a result of the shocks that we have been seeing. And I think that happens. I'm just not convinced that unless you have one of these extreme events that you get necessarily a recession just off the back of monetary policy already by the end of next year. The other issue on central banks, I would just note exactly as Seth said, second round effects are real. You don't fight supply shocks, but second round effects are real. If you have inflation, even for very good reasons, outside the central bank's control, sitting above the level that is acceptable, people ask for wage increases. It's a very different situation, certainly, than the 70s. You don't have everyone indexed. However, cost of living adjustments are making a comeback here in the US. So I do think that the longer inflation stays above a level that people stop thinking it's a sharp spike, which is unpopular but will come down, the harder it will be to avoid those second round effects, which I think are one of the factors which one needs to consider. And that's where central banks do have a role to play. On the easing side, I think central banks are rapidly running out of room. So, the ability to cushion the global economy from some of the shocks we're describing, I think has been severely curtailed by the extent of overexpansion over the last 3 years. So,
great. Let me collect two sets of questions. First from Thomas Kosberg, and then secondly from Colin Robertson. So first, Thomas.
Yeah, thank you very much, and thank you for the great debate. The question is, what are the conditions, macro data or events would trigger a pause in Fed tightening? Is it the housing market slowing? Is it business sentiment turning? Or are they going to wait for the employment market to turn before potentially pausing? So what would be the conditions to the downside, but also potentially to the upside? We already have wage growth of, say, 6% according to the Atlanta Fed median wage growth measure. Would it need to be 7, 8, 9% for them to accelerate tightening and hike by more than 50 basis points? Yeah, thank you very much.
So, do you want to start?
No, I want to, Colin Robertson, would you like to pose your question?
Sure, yeah. The Federal Reserve governors and the Fed generally are very reluctant to talk about equity market levels and what they would do at any given equity market level. So I'm surprised or very interested in your comment about the Fed wanting markets lower. So I'm not sure if you're kind of saying they hope markets would be at a certain level, or whether they actually would do anything to make markets move at a particular level. And what kind of levels are we talking about, be it for bonds or equity movements or indeed credit spreads? So are they going to react to capital markets?
Okay, great. Okay, it's this is Sonal's turn first.
Okay. All right. I was actually going to say to the first question, which is excellent, I'd only say one thing. I think for the first time in a very long time, the Fed can actually really look at only one thing, and that's inflation. So I think it's not, yes, in terms of if wage levels, wage growth accelerated even further, that might have impact on tighter, faster. But in terms of slowing down its pace of rate hikes, I think they're going to now need to see something happening to inflation and expectations. Again, if you're talking about market-driven expectations in five-year forwards and so on, they're very unreliable for the same reason, because we do have the Fed very present in both the inflation protected market and the nominals market. So I'm talking about actual inflation on the ground. And I think that's what the Fed has to actually focus on. And I think that for me, the asset price question is really more, not so much, I think the Fed would probably prefer to see asset prices lower, but my opinion is the Fed is not targeting asset prices. It's simply that so far in the post-GFC period, every time, in a sense, what I've said is that markets have been privileged over the real economy in the post-2007 period, and some would argue even prior to that, under Alan Greenspan. Markets have always been in prime position, in pole position, because the real economy largely cooperated by running post-GFC what I would consider unexciting growth, and inflation always relatively low and within target. This time around, the real economy actually takes pole position via inflation, not growth. So in a sense, the Fed, I don't think, is responding to markets. It will respond to inflation. That's how I would see it at this stage. It's not targeting, but it's not going to reverse its hiking because equity markets come down, unless you're talking about a 50% drop overnight because something catastrophic happens. And then, of course, all bets are off.
Excellent. Yeah, well, with the exception of that last comment, I completely agree that a 50% drop overnight catches everyone's attention and is a huge sort of shot across the bow. But apart from that, instead of quibbling, I'm actually going to disagree pretty strongly with Sonal's take there, but for a very specific reason. I think with inflation, no two ways about it. If inflation were 50 basis points higher, a percentage point higher than it is now, a percentage point lower than it is now, doesn't matter. Inflation is too high, full stop. There's just no two ways about it. And so as a result, whatever portion of that excess inflation is driven by macroeconomic overheating, there's just too much inflation and it has to come down. And so as a result, what could get much more in the way of tightening, I think, is actually a much stronger real side of the economy, because what the Fed needs to do is slow the economy down. They need growth to be below potential. And if growth is accelerating, then that means that whatever inflationary pressures there are is going to be worse. And inflation is just too high. It doesn't matter if it's too high by a percentage point. It doesn't matter if it's too high by 3 percentage points. It's just plain too high, and they need to bring growth down. So I actually think, perhaps perversely, because inflation is just off the charts too high, they need to focus much more on the real side of the economy and less, and inflation, whether we have 6% inflation at the end of this year, 5.5% inflation at the end of this year, doesn't really matter. If growth is still chugging along at 4%, that's the indication for more monetary policy restraint. And so I think it also, to some extent, goes in the opposite direction. So if we were to see, inflation, especially if you're measuring it on a 12-month change basis, it's going to take a long time. It's going to be inertial. If we get to the point where we're seeing non-farm payrolls coming in at 50,000 per month, bouncing between 0 and 100, I think that is very much a signal that they have slowed the economy down a lot. And then the question becomes, is it enough to bring inflationary pressures down? But that will be the sort of indicator, I think, getting real traction and slowing the economy down and getting indications that you're well below 2% growth would be enough to cause them to pause. When it comes to equity markets, so I think there are a few points I would make. And so my experience, sort of 15 years at the Fed, a bunch of time at the Treasury, and then now sort of the past, 7 years in financial markets vastly overestimate how much the Fed cares about equity markets per se. And if anything, if we went back to the last financial stability report, I think it was, their assessment was, if anything, equity markets at the time might have been overvalued. So some fall in equity prices at that point would have been welcome just to get things more equilibrated. And moreover, I guess, is the transition I wanted. They think monetary policy restrains the economy through financial conditions. And so as a result, there is an outright desire for there to be credit spread widening, for there to be higher interest rates, and all of those things helping to restrain the economy. What they don't have in mind is a specific numerical target, but I'm sure they have lots of charts where they say, you know, what happened back in 2018 when credit spreads widened. And it's going to be both a level story, a rate of change story, how wide were credit spreads, how fast did credit spreads grow. Then they'll get extra detail in the briefings based on what the flow of credit is. So if we're seeing credit spreads 50 basis points wider, but there's still a massive flow of new issuance, that's going to be a signal that the market can take that kind of spread and still have access to credit. And so it's going to be both price and quantity that they're doing, having either given or reviewed those sorts of briefings over and over and over again. I feel highly confident that they're going to be looking at both of those, but unquestionably tighter financial conditions is what they want to engineer.
Well, that was great. We've gone over time because this has been such a lively and excellent discussion, and there could have been 10 more questions. I want to thank Sunil Desai, Seth Carpenter, Steve Kamen in particular, and all the audience for joining us today. Fantastic discussion. And now that it's 9 a.m. here in the East Coast, it's time for you guys, or wherever you are, to get on with your real jobs of the day. So thank you very much, everybody.
Thank you, Mark. Thanks a lot.